I'm going to just go and give about 1 minute for you guys to stream in, right? For you guys to stream in, right? Because we do need to test this new restream restream tool that we're using to make sure it's working fine, right? Okay, I can see. Okay, here it is. I can see. Yeah, so if you're here from YouTube, if you're here from Facebook, please let me know, right? You can try the comment section, right? Because we're also trying to monitor all the questions that come through. So you can try to send a message through, see if we're able to receive it. Right? If I'm able to receive it, I'll let you guys know. Okay, right. Today's session will be done by me and Viko, who I'll be introducing in a moment, right? But otherwise, let me begin today's let me begin today's session. All right. Okay, so today's webinar is brought to you by by the guys over here at Everest Fortune, right? So we're best FX research for 2019, 2020, and 2021, and best equity research for 2020 and 2021. Right, today's session is quite straightforward. We're going to bring you guys some of the juicy stuff, the good stuff that has to do with price action strategies, right? A lot of the times people, people just look at candlestick patterns. Hey, Yosei, nice to see you, right? A lot of times people just look at candlestick patterns, but they don't really look into the psychology of candlestick patterns, right? So today we'll be explaining it. We're trying to break it down a little bit more for you to get a better understanding of just how candlestick patterns work, right? And why it works well. And of course, a small little nifty little tips and tricks which we do notice that actually helps you improve the probability of your candlestick patterns working out nicely. Okay, so without further ado, let me move on to the next slide. Right, to the next slide. Today, I'll be introducing to you. This is the team. This will be a team that will be taking you through the next few webinars. Right, there's me. There's Leong. Right, so I run this Everest Fortune group. Right, you've seen Cassandra. Right, hey Omokaro, nice to see you. Right, you have seen Cassandra. Right, she usually does the Tuesdays and Thursdays session, including the strategy clinic. And we have someone new here for the first time doing the webinars. Her name is Viko, right? So it's her first time doing the Vantage webinars, right? So do excuse her if she makes any small little hiccups here and there, right? So yeah, you'll be seeing her in a moment. All right. She basically everyone here at Everest Fortune, we know our technical analysis really well, right? Everything to do with price action. We're very strong in Fibonacci, support and resistance, correlation. You say it, we know it, right? And today we're just going to teach you one part of it, which is price action, right? Price action by itself, disclaimer, price action by itself, I do think they might not give you the best trading setups, right? Abu Bakar, nice to see you, right? So price action is usually best combined with other forms of analysis, right? Support and resistance, Ichimoku, trend lines, channels, right? Fibonacci, combine it with different stuff to increase the probability of you getting, higher probability setups. Okay. Now, for today's session, we're just going to break down a little bit into price action. But I do want to let you guys know, I do need to read to you guys, rather, the disclaimer, just something to take note, all right? That this webinar is purely educational in nature. So nothing in this webinar should be construed as investment or trading advice. So please do your own little due diligence before you guys trade, all right? Moving forward, right, we hope to launch our VIP rooms towards the end of this month or maybe next month, right? So the guys that you see here, going to put more and more. We're going to slowly grow our community, right? And anytime you have a question, you don't need to wait for a webinar. You can jump into the VIP room to ask us the questions, all right? The agenda for today, really quickly, a few of the things that we are going to touch on, all right? Firstly, I'm going to touch about the anatomy of a candlestick. Oh, shucks. All right, now I just assume I didn't cancel this. All right, anatomy of a candlestick. All right, so I'm just going to break down candlestick for you so that we all are on the same page on what a candlestick means. Then I'll be passing on the time to Viko, right, where she'll be touching about two things. When it comes to price action trading, there are really two ways to trade, right? One is the reversal, right? One is the, if this is a level, one is a reversal, one is the breakout, okay? There are two ways to trade when it comes to using candlestick patterns when it comes to using price action. Okay. Now, then she'll show you a couple of examples on how you can use them in trading. After that, we'll start diving into the psychology of single candlestick patterns, right? We'll show you what our top 3 single candlestick patterns, our top 2 double candlestick patterns. Actually, I think we're only going to focus on one triple candlestick pattern, which I think is something which worth paying a little bit more attention to, right? It's some of the slightly stronger ones. Okay. Now, lastly, Viko will be showing you how to combine them all together, right? Combine them all together to kind of create high probability trading setups, right? So it's not only about using a candlestick pattern, but also putting them together to create the highest probability setup, right? I think it's combining resistance, Ichimoku, maybe you can even throw in some Fibonacci, but how to apply what you've learned today in your trading. Okay. Now, if you guys have any questions, please send it throughout. I'll do Viko do our best to answer them along the way. Otherwise, let's begin today's session by just looking at a really quick anatomy of a candlestick. Right before I hand off the time to Viko, I'm just going to share with you really quickly. Right, I'm just going to share with you really quickly the anatomy of a candlestick. Right, so it's very simple. Right, usually, not all the time, right? Not all the time, you will notice that the bullish candlesticks are green and the bearish candlesticks are red, right? Sometimes some brokers use white for bullish, red, black for bearish. Some people use black and yellow, right? Black and orange. They got different kind of setups, right? But the important thing to take note of is that for bullish candlesticks, right, you just need to take note that the closing price, right, is above the open price. Okay, the closing price is above the open price. You will often notice this thing at the top and this thing at the bottom of a price of the body, right? Some people call it the shadow, right? Some people call it the wick. Okay, in our webinar today, we're going to more or less refer to them as a shadow and the wick, right? So this basically the upper wick that goes beyond the body of the candle, right? The place where it ends, that's the high price. That means that's the highest price that actually pushed it to. Okay, and the lower wick is basically the lowest price, which price actually pushed it to too. Okay, and then where it ends, right? If the ending price, basically a closing price, is above open price, it's a bullish candlestick, right? And if it's below price, it's a bearish candlestick, right? As simple as that, right? It is as simple as that when it comes to the anatomy of a candlestick. All right. So in the examples later, we should be touching on. We're going to show you some bullish candlesticks from bearish candlesticks, but this, at least with this basic knowledge, you know what roughly a candlestick is. Okay. Next thing we're going to touch on is reversals and breakouts. Right, this is where I'm going to pass on the time to our dear friend Viko. Right, be nice to her. Okay, be nice to her. It's the first time here, so if she makes any mistakes, let her know. Right, but yeah, she's a little bit nervous, jittery. It's fine. Right, it's she's really good at trading, really good at analysis. Just that it's one of the first times presenting to you all. Right, so if you have any questions, what I always encourage you guys to do is send them through. She literally has another screen open here, just monitoring it. Right. Otherwise, please lend her your ears as she explains to you the rest of the webinar on what's the best single, double, triple candlestick patterns, the reversals, the breakouts, and how she kind of analyze how she sees them from a psychological perspective. Okay. Thank you very much, Viko. Over to you.
Thank you, Desmond. Hi, guys. I'm Viko, and today I will be going through with you guys about how to look at the price actions. All right. Okay, let's look at reversals and breakouts. And if you have any question, you can feel free to type in the chat box, and I will try my best to look at it and answer your questions. Okay, for the reversal, as you can see, this is a bullish channel, and the price is starting to drop against the bullish channel, which is our supporting line over here. And that's a morning star formation, and you can see it here. So morning star is whereby there's a red candlestick, the longer one here, and the shorter green candlestick over here that forms the morning star formation. As you can see, the price is slowly dropping against this bullish channel. And price not only reaches our channel support, but also form a very nice formation. So these also give us increased confidence that price is going to bounce from this level. As you can see, is quite very near to the supporting level of the bullish channel. As you can see, price starts to bounce very nicely in the picture. This is a simple example of how you can combine simple chart patterns with candlestick patterns to find a potential reversal. Where is that? So if you want to trade for reversal, you can start to spot like where price started to fall from the top and almost like 70% to the bullish against the bullish channel, and you can start to going around this supporting level for a reversal for a bullish bounce. As for the breakout, resistance area to break through is over this area. I'll use my pen. So reversals to break through is around this area here. And this is a very strong overlap resistance. As you can see over here, this line. Excuse my terrible drawing, but yeah, this is the overlap resistance. So price happened to bounce here and here. That's why this is a overlap resistance that price has failed to break through. Okay. So this is the three shoulders that we call the three white shoulders that we call it, and we will talk about these three white shoulders later. Yeah, which is this. This is the three white shoulders. How do you identify the three white shoulders? So you try to identify them when they are very in a same shape, like same consistent shape, and there's a three candlestick over here. Like this is the first one. This is the first one here. The second one. And the third one here. And they must be in a consistent shape. So we can see how these three white shoulders are formed perfectly to break out of the resistance level. So this is a breakout. This is considered a breakout. So this point, this area is considered the breakout. And this gives us increased confidence that price is going to make a bullish breakout. As you can see, when it breaks up here, this area, it goes all the way bullish. So when you want to trade, you always find your resistance level that you want to find your resistance level, and also you want to find your entry point, right? So when it breaks this overlap resistance area, it rise up here for a bullish momentum. Okay, how to identify the top three single candlestick patterns? Okay, if you see this pattern, this is called the hammer because you have a longer wick here, and price trying to push it down, like all the way down, and it goes up here. And the hammer is normally stronger than hangman. So if you want to trade, you look out for stronger reactions, which you always look out for hammer. So the hammer candlestick pattern is stronger because it shows how the bears initially tried to push prices all the way down, but the bulls to override and push it all the way back up. And even beyond the open price. So open price is here. And closing as a green bullish candlestick. So on the other hand, the hanging man is a relatively weak bearish candlestick reversal pattern. So this is because the bears normally try to push prices all the way down here. Hence the long bearish wick. So it try to pull the way down. So this long wick occurs here. And but the bulls to override and push it back up again. Push it up again here and close just slightly below the open price. So there's a small red body here. But between the two patterns, you can try to focus on finding the bullish hammer candlestick pattern for slightly better reversals. Okay, next is the single candlestick patterns. So we have the inverted hammer, where you can see that the longer wick is on top of the candlestick body. And the shooting star here. So how do you identify them? So one is stronger than the other one is weaker. So the inverted hammer is weaker because it shows that price had gone all the way up but was pushed all the way down. So it's all the way up here, the price. But however, it was pushed all the way down from here to the bottom and closed near the bottom here, right? So when it closed all the way to the bottom here, it shows a sign of weakness, the price weakness, right? Whereas like for shooting star candlestick, you can see that the pattern here is stronger. You can see that the bulls try to push the price all the way up and try to push the price again all the way down here. But it fails to do so. And not only did the bears push prices all the way down, it also pushes the prices beyond the open and closed lower here. And hence it becomes a bearish red candlestick like. So whenever you, for example, whenever you see that the chart pattern, there's a short body and a longer wick here. Example for this inverted hammer means that it's going to be bullish. And where else you see on the shooting star, and you see that there's a small body, and there's a longer wick on top of it here, means that it's going to be bearish. Next, we'll be talking about how you identify the dragonfly doji and the greystone doji. And these are my personal favorite single candlestick reversals patterns. The dragonfly doji occurs at the bottom of a trend. So you normally will see at the bottom of the trend, like here. Now the strength of this reversal pattern depends largely on how big the dragonfly is. So if it's small dragonfly like that, it's not significant enough. You need to see a bigger one. And if you see a bigger one, is give you a clearer pictures of how the price react. So if it is a baby dragonfly, like I mentioned earlier, this is like a baby dragonfly, it will be easily squashed. And if it is a big dragonfly, like a big wig, like this is considered a big wig, then it is forced to be reckoned with and will lead to more successful bullish reversals. So this is okay. For example, if this is a weaker wig here, and we are, like expecting there will be a stronger bullish reversal, right? So the same goes to greystone doji. If it is a tiny greystone, if it's like a tiny baby gravestone. So like in normal case, not many people would notice it. But if it's a massive big gravestone, then it has a higher chance of a bearish reversal. So for example, let's take this for example. If okay, the price goes up to here and you spotted that there's a big gravestone, right? So you can go into a trade for, you can trade for a short. So it's good. So if there's a price here, so there will be like high chances or high probability of the price is going into a bearish reversal, right? If you see a big gravestone doji. Same goes for this one. So if you see like a big dragonfly doji like this over here, right? So most likely you will see, you can go in a trade for a long and you will see a bullish bounce over here. Okay, let's identify the top two double candlestick patterns. Okay, there's two types. One is the bullish engulfing and the other is the bearish engulfing. So the engulfing candle is one of the more powerful reversals candle that you can use or to identify your reversal trades. So a bullish one suggests that prices will rise after it. So bullish one, how can you identify it when you see that there's a, so this is like a small red one here and a bigger green one here, which means that it shows that it's a bullish momentum. So means that the price is going to be bullish and you can go for a long trade. And a bearish engulfing suggests that the price will fall soon, right? As you can see, this is a shorter green candlestick and this is a longer red candlestick. So you can identify this double and you can call for a short. But however, one super important point to take note is the size of candle 1 and the size of candle 2. So the candle 1, for this candle 1, you can be too tiny or too small. You need to be significant big. And if this one is considered small, right? But if this is considered big, so it's more significant. Then if candle 1 is a baby candle, there is nothing great to look at it. So this is, okay, let me identify this one, candle 2. Okay. But if, however, candle 1 is a relatively big candle and candle 2 is completely engulfed it, then that shows the engulfing candle is very strong. Another important point to take note of is that the engulfing candle should have as little wick, or you can call it like shadow, at the top and bottom as possible, because the lesser the wick, the better. This is because the wicks shows weaknesses of the price action. So if the wick is, so this is a good one, but if this is a bigger one, it won't be that good to look at if the wick is too long. But your shorter wick is better to look at it for these double candlestick patterns. So when looking for this, okay, this is called the tweezer bottoms. So tweezer bottoms is the same size of a candlestick. Same goes for tweezer top. The same size, the same two size of the candlesticks that is on at the top, at the resistance level. So when looking for these tweezer patterns, you have to ensure that they are consistently the same size and should not be oddly shaped. So how do you identify this? So if this is the same, this is good. But if this is like kind of like a shorter one and this is like a bigger one, this is not valid. Or this is a bigger one and this is a shorter one, this is also not valid. So they have to be the same or almost the same, like this. So very, very often we overlook this point, and is that the tweezer length should be roughly the same because it gives a glimpse into the psychology of the market. And the tweezer shadow should be roughly around 50% of the entire candle. Just like I say, not too big and not too small. They can be the same, or if you can find like almost the same, you can find roughly like about 80% the same. Next will be the triple candlestick patterns that we are going to look at. Okay, so we have two types. We have the morning star and the evening star. So how do you, okay, so for this is just an example, right? This picture. Normally for the FX trade or the FX charts, the gap is not that wide. They are always very close and nearer together. So how do you identify a morning star? Is when you look at this, that, okay, if you spot this shape, this is a morning star shape. When the sun is going down and it's going to rise from here. An evening star shape is the opposite, right? The sun is like going down. You can see it here. But to be honest, I think that I personally feel that morning star is not as strong as what we talked about it earlier. The one stronger to see is the double stick and the double candlestick, and also the dragonfly and the greystone patterns. Okay, let's look at the triple candlestick patterns. So we have two types. One type is the three black crows, and the other one is the three white soldiers, right? So the three black crows can occur as a sign of reversal of a trend. So it's normally happen at a resistance level. Let's say this is a resistance level of a chart, right? So normally you can see like it's at the right side, right here. You can identify it. And it can also occur as a sign of a strong bearish breakout. So how do you identify these three black crows? They have to be, the three candlesticks have to be consistently similar, like the same shape, same size, same length. They have to be the same. And they have another factors that have to look at is they also need to be fully grown crows. They cannot be baby crows. If they are a baby crows, it's not considered a valid one. So they have to be full grown to consider as a valid one. So for example, if you see like a same small one, this is not valid. Or example, if you see another, okay, for example, if you see this one, so this is not valid. Okay, this is also not valid. Or you see like this one, it's also not valid. So it has to be a bit like consistent shape and a bit the big consistent length, then it's a valid one. Do take note that the wicks or the shadows cannot be too big too. So it means that the shadows to be another factors to be a valid one is the wick has to be a smaller one. So this is okay. But if this is like, if the wick is too long or too big, this is not okay. This is not valid. And a white reverse and a white soldier also occur as a sign of reversal of a trend. So if you see this one, the black crows, it means that there will be a bearish reversal happen. It's going to be bearish reversal. Okay, next will be the white soldiers. So similar to the three black crows, we need a fully grown soldiers and not a baby soldiers here. So this is, so you have, if it's like this, the same, and a long wick, this is not okay. Okay, this is definitely not okay. It's not valid. So if it's like a shorter wick, with the same shape, same height, and this is okay. So think of the top wick as their head and the bottom wick as their shoes. The main body and legs of the candle body should form the majority of the candlestick. All right. Okay, how do we combine them together? So we have candlelight. We can candlelight stick to tell the price, how the price actions reacts. We also have other indicators or techniques to combine them together to see, to make it like a higher probability of a trade. Right. Okay, combining them together. Let's look at this. Okay, by the way, those who might not know, or I don't know if you guys know about, this is a Ichimoku cloud indicator. So if the price trade below the Ichimoku cloud, is a bearish momentum. And if the price trade above the Ichimoku cloud, is a bullish momentum. So right now, as you can see in this chart, the price is trading below. Okay, you can see this is the price, right? And this is the Ichimoku cloud. You can see that they are trading below this cloud. You can see that they are trading below this cloud. So this shows a bearish momentum. And if you can look at it clearer, there's a pullback resistance. So price is here. Price started to drop, but as you use your pen or use your horizontal indicator to trace it back to this area, you can notice that this is a pullback resistance. So with the pullback resistance, that expect the price where it touches here, right, where it touch this resistance level, there's a high probability that the price might have a bearish reversal. All right, unless sometimes you cannot be like 100% sure that okay, the price is going to be like that, but it's a 90 at least a 80 to 90%. But what if the price is not going to go along the direction of bearish reversals? It's going to have a breakout here. If it's going to have a breakout here, it's going to be a bearish if there's a breakout. Okay. So price forms a bearish engulfing candle at the Ichimoku plus pullback resistance. So this gives us more like confidence that the price is going to drop. Okay, since when the price touches here at our pullback resistance, okay, means that it tried to break, but it didn't. The breakout didn't occur, right? So when it touches here, the price started to slowly, consistently, slowly falls, drop, right? So these give us confidence that the price is going to drop. And also, just like I mentioned earlier, Ichimoku cloud showing that the price is trading below the cloud indicator. So this further support our bearish bias for this trade. So in the future, as you learn from techniques, from we have different techniques. There's a Ichimoku cloud indicator. There's RSI. There's MACD. There's also stochastic. All these techniques you learn in the future. You also can train trend lines. You can use trend lines also. If you know channels, you also can use channels. If you know how to use the right way of doing Fibonacci, you can also use it. It's also quite accurate to predict the entry price and your take profit and your stop loss, and also correlation. You also can use it, and there's a lot more, to use to improve the probability of your trades being successful. And most importantly, do not trade these candlestick patterns in isolation. You can try your best to combine them with other techniques. Yeah. Oh, which time we using frame? Normally for day trading for FX, we use H4, the 4 hours time frame. But if we are looking at stocks or we are looking at commodities, we will use the 1 hour time frame, because like the stocks and the commodities, they are moving, the price moving slower than the FX market. Yeah. By the way, okay, we are coming the end of the slides. All right. Thank you for staying throughout these webinars. Okay. I hope you guys found it useful in equipping yourself with the knowledge to use candlestick patterns in your trading strategy. So at Vantage Market, we are always looking for ways to teach better and equip you with knowledge and tools to trade better. Right. By the way, join us this Thursday, because my colleague Cassandra, she'll be running the strategy clinic, and she will also help you diagnose your trading strategy in this live interactive section. Anyone want to look at chart before I end the session? I can do one live chart if you guys want to. Any requests of one chart that you want to look at? Any requests for any chart that you want to look at? You mean AUD USD? Okay, let me see. Right, give me a minute. Okay. Okay, let's see AUD USD. Okay, wait. What is that? AUD USD. Okay, normally for FX pairs, right? Like I said, the currency pair, we always use the 4 hour 4 hour time frame to look at it. Right. So now, as you can see, okay, let's see if there's any trend line first. All right. Okay. there's no valid trend line here. Okay, let's find our supporting, let's find our resistance and supporting level. I'll place my resistance level over here. Okay. I'll place my first resistance level here, the second resistance level over here, and my first support level will be here. Okay, so my entry point will be around here because, as you can see, maybe for the previous from the previous day, price already went up, rise up to this first resistance level. So we can play a reversal. We can play a reversal down for a bit. Okay, I don't know if you guys know how to use Fibonacci, but I will just show you the Fibonacci way. All right. It's another type of techniques to predict the entry price and the take profit price. Okay, I've seen there's a 78.6% here. This is quite a good level. Okay, you can see there's another Fibonacci extension. I don't know if you guys know how to identify, but I'll just do it because there's no time to explain so much about how does the Fibonacci works unless you have been to the webinars of the whole series of Fibonacci webinars, then it's easier for you to understand. Okay, I can't work with this. Okay, so okay. Okay, I'll just find my support level for the levels. Oh my god. What is this? It might be off it. Okay. There's another 78.6% Fibonacci projections line up here nicely with the 78.6% retracements here. So this is considered the Fibonacci confluence, which is a very strong levels of Fibonacci. So this can be your take profit. This is your take profit level. Okay, that's a 38.2% of retracement here and here. This line up very perfectly here. Okay, so we have these and these levels. Okay, let's see if I can find any projection level for this. For them to for this, the purpose for the Fibonacci projection is to project the next price. They have these 61.8%. This is a very good stop loss level. I'm going to find my expansion. Right. Okay, so now we have a Fibonacci level for all these three levels. This is our entry point, and this is our take profit, and this will be our stop loss level. So we are going to play for a reversal here. So we expect the price, when the price reach here, right? The price is already reach here, but you can wait for a bit, for the price to touch here, and it's going to have a bearish reversal down. So we are playing for a short, and this level will be our stop loss. You can see that these two, they are quite pretty, like they are not that weak, they are quite strong because they have two levels of Fibonacci. But also you can use indicators, like I say, indicators to support your trade. So if you go indicator, for example, I go to Ichimoku. Okay, maybe this is not the best. Okay, wait first. Okay, this is not the best. If you use stochastic, okay, you use stochastics and you can see that, all right. Okay, this is at a resistance level. Every time the price touches here, react here, it go for a bearish reversal, a drop here. So whenever the price reacts at this area, it goes for a drop here. So it goes for the same here. So it just reacted here, right? So it's going to have like a short retracement, short bearish retracement down here. So you can play for like a short retracement. Like you can go for a short. Okay, any questions? Because you are going to end. All right. Thank you for being throughout this session. Yeah, if there's no questions about this gold trade, then we'll be seeing you on Thursday, whereby my colleagues will talk more about the strategies. Let me see. Yeah, she will be talking more on Thursday about the strategies clinic, and she will help you to diagnose your trading strategy in the next live interactive session. And okay, thank you once again. Now our webinar is coming to the end, and thank you once again. And catch you guys next week. Hope you guys have a nice days. Or if you have any questions, you can type in this chat box. And if you have like questions that I have no answers, or yeah, you can ask during the next live session that we are going to hold it on Thursday. All right. Thank you so much. Have a good day ahead. Bye, guys. You can also use the resistance or the support level to see where you can play for reversals for the trade. Not necessary that we always use the candle, but yes, we do looking at candles like sometimes. But mostly we use Fibonacci techniques to enter a trade. But yes, but you still can identify here in a trade. Let me see if this is a good trade that I can identify. Yeah. This is not a good trade here that can identify. Yeah. But yes. Yes, there will be a short retracement on gold. because as you can see, it already went out and touches this resistance level here, right? So you will retrace a bit back, like down for a bit, like retrace back, like going short for a bit before it reaches this support level for another bounce. Okay, anyway, see you guys next time. See you guys on Thursday. Bye, guys. Have a good day. Thank you so much. Thank you so much.